QuickBooks Pro Plus Desktop 2022 OneNote Presentation Deposit Form. Let's get into it with Intuit's QuickBooks Pro Desktop 2022. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon left-hand side, the Topic Introductions tab down in the 1380 Deposit Form tab. Also note, when using OneNote, take a look at the Immersive Reader tool. Topic Introductions also in the text area, same name, same number, but with transcripts. Transcripts that can be translated into multiple different languages and either listened to or read in them. Also note that the topic introduction will have the same name and number as a presentation. Topic introductions designed to give an introduction to the topic, provide screenshots, links where applicable, and give some accounting background to support the information we'll be looking at in QuickBooks. Closing the icon on the left-hand side, we're looking at the deposits this time. We've been focusing in recent presentations, the customer section, otherwise known as the flow for the customer cycle or the sales cycle or the accounts receivable cycle. And we're looking now, this is a close in at that cycle, the deposit form, which you can see is actually out in the banking section, but we're hoping that most of the deposits are actually from the customers, so therefore it's kind of linked to the customer section in that way. Now, at the end of this presentation, we will do some more information with regards to journal entries so we can get an idea of how QuickBooks will be building the financial statements with relation to deposits for different purposes. If you're following along with QuickBooks and the presentations and you don't want to have QuickBooks open, you could use these screenshots as a guide to follow along with it. Note that if you're looking at this end cycle of the deposits of the customer cycle or revenue cycle, we could get there by either going through the full accrual process, invoice, then receive payment, and then put that into undeposited funds when we get the payment, then make the deposit. Or we can imagine a cash register type situation where we get paid at the same point in time, take that money, and then go to the bank and make a deposit with it. Or you can imagine a situation where you're in like gig work or something like that, and you make the deposit directly into the deposit, possibly with the bank feeds right when you receive it, without going through an invoice, receive payment, or create sales, making deposits directly into the system. Or you could have an increase to the checking account, in essence, by creating an invoice and using the receive payment to deposit directly into the checking account instead of taking it from the checking account and then going and deposit it into the bank account. So when you think about an increase, in other words, in the checking account, the primary form we think about for that increase is a deposit form. We're hoping that most of those deposits are coming from the customers in some way, shape, or form, although that's not necessarily the case. For example, we could get a loan and get a deposit, or we ourselves, owner, could put money into the bank account, increasing it as well. This number 2 in the deposit form represents that there are items basically reflected in undeposited funds, meaning they went through the receive payment, they went through the create sales receipt, one or the other, and went into undeposited funds, and they're waiting to be deposited, going through that special technique, which would QuickBooks makes it easy to do, which would be to group those deposits together so that when they do the bank reconciliation, it'll be grouped in the proper format. So that's the idea of this deposit process. If I personally have deposits that are not coming from undeposited funds, going through, in other words, receive payments or create sales receipt, then I'll often use the check register to make those deposits and use this actual deposit form in order to enter the transactions that are going through undeposited funds. If you go into that deposit amount, and here are those two items that if you were to check them off would then be combined together on one deposit sheet so that they would be deposited into the checking account at the same time. These two are coming from either then the create sales receipt or the receive payments and would be reflected on the balance sheet in undeposited funds. If you clicked both of them off, you would have them added here, summing them up. That sum total then is what's going to show on the bank reconciliation and in the general ledger for cash instead of two separate accounts, allowing you hopefully to reconcile the total amount, which is what we're imagining is going to go into the bank, actually physically into the bank, so that we can reconcile by checking off the $2,440 to what's on the bank statement as opposed to the $440 and the $2,000 separately. If you were to use the same deposit form for some other kind of deposit, then you would not use this first screen, and you'd simply then say, I'm going to put it into the checking account and assign some other account, such as a loan account or equity from the owner. On the balance sheet, clearly we're looking at the checking account with regards to the deposits. The checking account, this is an increase to the checking account, which is generally thought of with the normal form for an increase being the deposit form, increasing the deposits, although we could also have the sales receipts. We can also have the sales receipts if we deposit directly into the bank account at the sales receipt point, and we can also have the received payment if we choose to make those deposit directly into the bank account. Those could also be items or forms, types, in other words, form types that could be increasing the checking account. Now remember that the checking account is the most complicated transaction detail report to look at because there's going to be more activity, more different types of transactions in it than any other, cash being the blood flow in essence of the company. And so every other account, such as undeposited funds here, which only represents those money or that cash that has not yet been deposited and is waiting to go to the bank, will have a more systematic structure, it going up then with the payments that we're receiving, and then goes back down with the deposits. So you should see a systematic, a normal tick and tie kind of format with the undeposited funds account. And then here's going to be a look at the customer payment. So these are the customer payments, and now we're going to think about it from an accounting standpoint. Now, when you're thinking about an increase to the checking account, there's a couple ways that we could see that happening. We could have the customer payment, the receipt of the customer payment after you invoice, and then you get the customer payment. We could deposit that directly into the checking account, or we could take that and put it into undeposited funds and then deposit them from undeposited funds into the checking account. And then on the right-hand side, we've got the deposit form, which oftentimes will come from the customers coming out of the undeposited funds when we're thinking about the accounting process in the QuickBooks system. And then down here, we can also make a deposit directly into the checking account if we so choose, just simply assigning the other account down below. This would be the method that I think would be good to use if you're not going in and out of undeposited funds and just depositing directly into the checking account and would just simply like to assign some other account, and you don't have to worry about the grouping kind of problem as you do when you're using that undeposited funds account. So let's look at a few examples just from a journal entry type of standpoint. This first journal entry is an invoice type of journal entry. So we're going to imagine an invoice and the journal entry transaction related to it, and then we're going to receive payment on that invoice. So the invoicing process, as we would see in the past, would be accounts receivable goes up and sales goes up. This would be the journal entry behind a sales type of transaction, not selling inventory in other words, but a service item. So if we had our beginning balance on the left-hand side, activity in the middle, ending balance on the right, the accounts receivable would go up from 2,000 up by 1,600 to 3,600, and the sales then would go up. This is our revenue account, by 200,000 up by 1,600 in the credit direction to 201,600. If we take the 201,600 minus all the expenses that were there before that, we get to the 26,310. So in other words, we started at the 24,710 in net income. That's income, not a loss. The brackets representing a credit goes up by 1,600 to 26,310 at the end of this process. Looking at the general ledger account, similar to the transaction detail, the accounts receivable goes from 2,000 up by 1,600 to that 3,600 found on the trial balance. The sales go up from the 200,000 up by the 1,600 to the 201,600. And then if we looked at the accounts receivable subsidiary ledger, we're going to see down here, this is our customer that we're assuming down below. And we actually have two transactions here, but we're looking before this second transaction took place. So sorry about that. Hold on a second. Let's pull out the trusty calculator just to double check this calculation. We're going to assume this second one hasn't yet happened. So we got the accounts receivable should be then the 1,600 plus the 600 plus the 400 plus the 1,000 for the subsidiary ledger, 3,600 instead of the 2,000 to get to this 3,600 up top. So then we're going to go on down and say, now we're going to receive the payment. Now, I'm putting this green here because we're kind of putting it directly into the checking account this time. In other words, we're imagining this would be supporting the receive payment or customer payment form. But instead of putting it into undeposited funds, we're using this form to put it directly into the checking account. Therefore, if you were to look at the transaction detail for it, say in QuickBooks, it wouldn't be going to a deposit form in this case. It would be going to this customer payment form, which we deposited directly into the checking account. So that's kind of an exception to the deposit form being the only form that kind of increases the checking account. And so then if we were to record this, it would be an increase to the checking account because we got a payment from the customer. The other side then decreasing the receivables. So the checking account then going up by the 100 from 100,000 by 1,006 to 1,016. And between the two transactions we have seen up top, the accounts receivable goes back down to its original amount of 2,000. The activity down below in the general ledger, we started at 1,000. It went up by the 1,600 in the checking account to the 1,016. Accounts receivable started at 2,000, went up by 1,006 to 3,006. Then it goes back down because we got paid by 1,006 back to the 2,000. So then the subsidiary ledger, let's see if we got the right one this time. We're saying down here, it went up and then it went back down again. And so the total of these four customers we're saying is that 2,000 matching on the general ledger. So let's see another scenario here. So now we're going to skip these first two. We're going down to this 410. We're going to put the receivable back on the books. The difference here is that when we receive the payment on it, we're going to assume that the payment goes into undeposited funds, adding that added level, which is often confusing to people that learn accounting in like a school setting, because oftentimes we don't use, when you're just learning accounting, checking account versus undeposited funds and worrying about having to deposit in the same way as it's going to be put into the checking account because we just call it cash. Cash is cash, but it's not, because we want to reconcile cash. So we have the checking account and we got to be able to reconcile our books to the bank, which is a really huge internal control. And we want to do what we can to make that as easy as possible. So now we're going to put this is an invoice type transaction back on the books. Accounts receivable this time going up by 1,004. Sales going up by 1,004. This would be a transaction related to like an invoice. Accounts receivable starting at the 2,000 goes up by the 1,004. It's actually going up, down, and then this 1,004, but these two net out up top. So really 1,004 to 3,004. Sales then is at the 200,000 going up by 3,000. That's these two transactions, this 1,006 and this 1,004 that are being impacted. There's the 203. So that increases the net income at the point in time the sales was made or invoice was made, not when we received the payment. If we look at the accounts receivable now, it went from 2,000 up by 1,006 to 3,006, down by 1,006 to 2,000 again after receiving payment on the first invoice. Another invoice went out by the 1,004, bringing it up to that 3,004. Sales was at the 200,000. It went up by the 1,006 to the 2,016. Then it went up by 1,004 to the 203,000. The sub ledger then down below, we have this activity. Now we're assuming customer 1,000 goes up by the 1,004 to the 2,004. The four customers then, if we add them up, adds up to the 3,004, tying out to the general ledger for accounts receivable. Scrolling down, the next transaction then, we're assuming this time now we're going to receive a payment. So now we're looking at this form, but instead of making it go directly into the checking account at this point, we're taking it into undeposited funds because possibly we're going to get multiple payments in some way. Possibly we have multiple different credit card payments or cash payments typically are the two that need this kind of process, so that we can then group them in some way if they were cash, for example, and then take them to the bank and deposit multiple cash receipts that we receive from multiple customers in one deposit, wanting to reflect in our bank the same way that it is on the bank statement in our books so that we can reconcile. So this time we're going to use that clearing account. This is the new step. This is the added step. This is something that most people learning accounting just from a debit and credit standpoint don't understand, causing many problems when you move to accounting software. So we're going to then increase the undeposited funds basically a checking account, but not yet in no, it's basically a cash account, but not yet in the checking account. Also note that in QuickBooks, this undeposited funds is not a cash type of account, or it's not a checking type of account. They put it in other current assets because it doesn't act like a cash account, meaning it doesn't have bank fees related to it or anything like that. And so that's another reason it can be a little bit confusing. So in any case, it's really kind of a cash account though, $1,400, because you're holding on to cash. The other side going to accounts receivable. Also realize that this undeposited funds should be what I would call a clearing account, meaning it goes up and then back down. That's different from a temporary account. The income statement accounts down below are temporary as opposed to the balance sheet, which are permanent. That means that every period, every month or year, they close out to the equity section and start over again. A clearing account means that it's going to go up and down in a very short period of time. You're using it for a specific purpose in order to kind of group your accounts together, or some purpose that's a very short-term purpose. So that's what the undeposited funds will be. It's going to go up, then it's going to go back down. We're going to use it to group our deposits in the way that we want them to when we put them into the checking account, so that we can more easily reconcile with the bank statements. Okay, bank statements. So let's increase the undeposited funds. It goes from 0 up by the 1,400 to the 1,400. The accounts receivable goes back down now because we have received the payment on it. And then the next step is to move this back up. Now note there's no impact on net income when we got the payment, because we put the net income on when the receivable was on the books. Undeposited funds was at 0. It goes up by 1,004 to 1,004. Accounts receivable was at 2,000. It went up by the 1,006 to 3,006, down by 1,006 to 2,000, up by 1,004 to 3,004. And now finally we got paid, so the receivable goes down by 1,004 back down to the 2,000. The accounts receivable subsidiary ledger, it went up by 1,004 for customer 1, went back down by 1,004. It's now at the 1,000 again for that customer. Adding the 4 customers up gets us to the 2,000, which matches out the accounts receivable on the general ledger. So then, so that's going to be then the next step here is we're going to say now we have it in undeposited funds. I want to take it out of undeposited funds and put it into the checking account. So at the end of the day, when we get all the cash accounts, or when we think about all the credit card transactions possibly, and we know how they're going to be grouped when we put them into the checking account, possibly because we're going to group them in that way and walk to the bank with a bunch of cash and then dump it into the bank, then we're going to group it together. Now we're just going to use the same amount here instead of having multiple transactions. If we only had one transaction and it was like a check, then we could possibly put it directly into the checking account, and that would be fine because the matching would work up. But if it was like an electronic transfer, for example, but if it's going to be something different, that's really when the undeposited funds going to be useful, and that would happen if we had multiple transactions like the ones up top, receiving multiple payments that are going to be grouped in the checking account in some grouped fashion, possibly due to cash transactions, possibly due to credit card transactions. So in this case, we're going to increase the checking account, 1,400 other side going to undeposited funds. So now the checking account's going up from 100 by the 3,000. That's the 1,004, and this 1,006 up top to the 301,000. And then the other side is going to the undeposited funds, which goes back down to 0. So all we did was move the amount from here up into the checking account. The GL for this account, the cash was at 100,000. It went up last time on 3/25 by 1,006 to 1,016, up by 1,004 to 103,000. And then the undeposited funds was at 0. It went up, and then we cleared it right back out at the same day because we went to the bank at the end of the day and deposited that 1,004 into the checking account. Let's try another transaction. This will be a bit more unusual one. This one, we're going to say that the owner put money into the checking account. So we, the owner, put money into our business checking account. So in that case, you could use the same deposit form, like this form here. You might most likely do that with an electronic transfer, however, and you might just put it into the system with using the check register, because you don't need that grouping system for the undeposited form. So you could just go into the register, or you might simply use the bank feed, to help you with the recording of that transaction. So if you were to record it, then the checking account would go up by the 10,000. The other side would go into something like equity. Now, this is also important because if you use something like bank feeds or then in QuickBooks to record your deposits, it's likely that you're going to say everything that's a deposit is income. And if you record your own money that you put into the checking account or a loan or something like that as income, you're going to distort and overestimate or over-report your income line item down below. And that means that if you're paying taxes on it, you'd be paying taxes on your own on your own money that you put into the business. So what you want to do is make sure that that's going to some kind of equity account, and it might be called like owner investments. But a lot of times people put it into the owner equity account if it's a sole proprietor account, and then that's going to be the owner investment. If it was a corporation, you would be issuing stocks and whatnot. It would be a more transparent kind of way, but more complicated. But same kind of thing. In any case, it's got to go into some equity account. So we're going to increase the checking account. So that is part of this $13,000 increase in the checking account. The other side, importantly, is not going into the income line item, but rather into the owner's equity line item for this amount, increasing the equity. Now, also note that if you do deposit it directly into the equity, you got to make sure that you understand that when you do your taxes and whatnot at the end of the time period or your financial statements, because you're going to need to know that amount is there so you can roll over last period's equity to the current period's equity. And so that's going to be, so the transaction there would be no impact on net income because the sales or anything below the sales item, the income accounts, income and expenses are not affected. And that's going to be the point of that. So then the checking account was at the 100,000. It went up in the past by 1,006 to the 101.6, up by 1,004 to 103,000, up by 10,000 to 113,000. Equity then went up to the 92.65, up by 10,000 to the 102.65. This is unusual because we don't usually report something or record something to equity or in a corporation like a retained earnings or something like that, because in the balance sheet, this equity is usually used only to have basically the net income roll into it in the closing process, and QuickBooks does that automatically. So again, when you do your taxes or the financial statements at the end of the year, if you put money into the business and you put it into the equity account, then you got to basically get the transaction detail with that so you can reconcile your prior period equity to the current period equity. We'll take a look at that briefly when we look at the financial statements. So then the next kind of transaction you could have is the loan. You might take a loan out. And so once again, you'd have a deposit into the checking account because you got money, but it didn't come from a customer in that case. Once again, in that situation, you could use a deposit form, but you might deposit it directly into the check register, which would still ultimately use a deposit form, but the data input would be in a check register kind of format. Or you could use kind of bank feeds again in that kind of transaction. And that would be the transaction of checking account goes up by 20,000, and then you'd have a liability going up by the loan. Remembering again that you don't want to put this credit into income because it's not income that you got the cash from. You didn't get it from a customer. You didn't get it from goods and services that were sold. You got it from a loan, have to pay it back, and therefore it shouldn't be on the income statement. So the checking account goes up. Part of this 33,000 is now the amount we're assuming we got from the loan. And then the other side, not going down to revenue. We didn't credit the revenue. We made another account called loans payable, increasing the loans payable by the 20,000 liability account, no impact on net income. Checking account now has going up by the 100, from 100 by the 1,006 to the 101.6, by 1,004 to the 103,000, by the 10,000 to the 113,000, and the 20,000 to the 133,000. Loan payable going up to the 20,000. So there we have that item on the loan. So then if you look at this full kind of process, and we'll look at the financial statements here of entering these transactions, these would be the transactions behind basically the deposit forms or other forms that are making the increase to the checking accounts. And then that would be recorded typically to the general ledgers here when you're thinking about what the QuickBooks is actually doing, which is kind of like the transaction detail report. That would then be used to create the trial balance, which we kind of broke out as well so that you could see these few transactions and their impact from the beginning to ending balances. And as you enter this into the system, QuickBooks would require you to give the added information when a sub-ledger account is needed. In this case, for example, accounts receivable, every time you enter something into an invoice or a receive payment, QuickBooks forces you to give them the customer so that QuickBooks has the information to, at the same time, make the subsidiary ledger, which we've been thinking about manually every time, so that this thing should always tie out to the primary ledger, to the general ledger, and then they would use the trial balance in order to create the financial statements, the balance sheet, and the income statement. So when we look at the balance sheet and the income statement, we're tied out here. Note that what was different here on the statement of equity is when we put that owner investment in place. So that $92,000 beginning balance actually, when you look at the trial balance, doesn't come like it normally would from this number. This number right here is usually the beginning balance because no activity would have been put into the equity section yet. And that's kind of the tricky thing about converting the trial balance to the financial statements, which QuickBooks kind of does for you in general. But when you have a situation where something was posted to that account, then you got to get to the beginning balance at the beginning of the time period to tie it out to the prior year equity account. So that's going to be important if you do financial statements, at the end of the year as part of your tax preparation possibly as well. So that you need to break that out. And then that's going to be your adjustment and your net income to get to the ending equity. We do that. We talk about that in the Excel more closely. So if you want to dive into that issue more closely, and that's possibly that causes you problems as an accountant, which it often will if you're working with business clients and trying to do their accounting and their financial statements and whatnot at the end of the year, you could check that out. And then you would look at your information here, possibly drilling down on, say, the checking account. If you were working in QuickBooks using the double-click zoom feature, which would take you to like a general ledger account, which would be something like this, which in QuickBooks would be called some kind of transaction detail report, giving you the detail by date. If you looked up the detail by date and something like the accounts receivable or something, you might say, hey, I'd like to see that also broken out, not by date, but by who owes me the money, some kind of subsidiary ledger, which would look something like this, which would be in QuickBooks something like an AR aging, AR detail, accounts receivable summary report.